Dave. Let's talk about all this, what it means for the Fed, what it means for the market going forward. We want to bring in Jordan Jackson, JPMorgan Asset Management Global Market Strategist. Jordan, it's great to see you. So looking at losses today, the Dow off nearly 500 points. We got some weak econ data, retail sales coming in lower than expected, some hawkish comments from Fed officials today. How are you looking at the drop at today and what this means for the markets going forward?
Sure. I think the markets are trying to figure out just how weak growth is going to be or how much growth is going to slow down in the economy over the course of this year. And so obviously we're seeing some cracks amongst the consumer, given the retail sales number. Now, I know this is not adjusted for inflation. So we did see a 9.5% drop in energy prices last month, core goods prices coming down. So I think that all sort of filters into some of the retail sales numbers. We also have to recognize that it is very goods oriented, the retail sales figures. And so we continue to see signs that consumers continue to shift towards paying for services versus buying goods. But on balance, as we look at some of the manufacturing data, some of the ISM numbers, all continue to signal that the economy is certainly slowing. Now, the question is going to be, are we headed for a soft landing or are we headed for a hard landing? And so I think, again, markets are trying to figure just what kind of landing the economy may be headed for.
On that regard, Jordan, what's your expectation? Can we avoid a recession?
Well, I think we can. The reality is the labor market continues to some extent be firing on all cylinders. I will say, though, it does seem like we're seeing a bit of a divergence amongst small and medium-sized businesses and some of their larger counterparts. I travel across the country and speaking with business owners, they can't hire workers fast enough. They're really struggling to find a qualified labor, and that could very well keep the wage growth number somewhat elevated. I mean, we still expect a bit of cooling in wage inflation, but still a little bit high. And certainly we're seeing layoffs amongst the larger companies that probably did a little bit of overhiring coming out of the pandemic. And so, I think we're in an environment which if inflation continues to come down, wage growth continues to remain fairly firm, we could actually see real wage growth turn positive by the middle of this year, providing a bit of support for consumption growth over the course of 2023.
Yeah, you mentioned the layoffs, in particular, really isolated on the tech sector for the most part, besides Goldman Sachs, 3,000 plus. When or if do you think they spread well beyond the big tech?
Well, I always try to remind our investors, right? Technology as a sector really only counts for about 2% of the overall labor force. So I do recognize that these are large companies that are taking up a lot of headlines, but we just aren't seeing that sort of widening out or of labor market weakness. And so, again, we look at small and medium-sized business, they're still clamoring for workers, qualified workers. There's still an excess demand for labor out there, some 10 million job openings to 6 million unemployed. And so, it's difficult to say. We're just not seeing signs. Initial unemployment claims also continue to run at very, very low levels. And so we're just not seeing any clear signs that this labor market weakness is broadening it out outside of the tech sector.
Jordan, investors are putting a lot of emphasis, placing a lot of focus on the earnings results that we have gotten and what we're going to get over the coming weeks. We've only gotten just over 30 of the S&P 500 companies have reported so far, but there's a lot of doom and gloom projections heading into this quarterly results. What do you make of the reports that we have gotten so far?
Sure. So on a year-over-year basis in the fourth quarter, we're now tracking a roughly 7% decline in earnings per share growth. However, quarter over quarter, so from 3Q over 4Q, are expecting modestly positive results. And I think the year-over-year numbers are more so reflective of a lot of the pressures that we've continued to talk about over the course of 2022, higher input costs, higher wage pressures. But we're seeing signs, at least over the fourth quarter, that some of those pressures may have eased a little bit. And it was talked about a little bit earlier. It's really a sector by sector case. Right, we're still expecting to see energy, healthcare, industrials, particularly airlines and transport, deliver positive earnings growth. whereas the tech sector, communication services, discretionary look to be coming under a bit of pressure. And so, in portfolios, we're still leaning a little bit more defensive. While the defensive sectors are certainly taking it on the chin today, they tend to be a bit more stable as we think about a volatile earnings seasons relative to some of the more cyclically orientated sectors, again, like technology and energy, for an example.
Great stuff there. Jordan Jackson, appreciate it.
Thank you for having me.